Yep, it's working. What's going on again, YouTube world? Man, how y'all doing? Hope everybody's having a good weekend. Hope everybody's been having a blessed just year. You know what I'm saying? It's almost coming to an end. But I finally started to name these episodes. This is episode 1 of Stability and Freedom. Okay, I started just putting a name to these episodes now. So this is episode 1 of Stability and Freedom. Still on the financial literacy courses on my playlist. If you check those out. But yes, that's the name of these channels, of this show now. So welcome to Seven Band Financial Agency. I'm your cash flow consultant, Malik East, and I'm here to help you all take control of your finances and just, be more self-sufficient and self-assured so that you can be in control, right? So into today's episode, I'm just going to talk about using 4 keys. Yes, I said it. Keys to choosing a good financial vehicle for your cash flow. We need to make sure we got our cash flow in a good, right financial vehicle that's actually good, that can actually pass this test right here. Okay, because I created something that I want you guys to see that inspired me by this book I've been reading called The Laser Fund. If you haven't heard of it? It was by this financial guru, Doug Andrew. He's been in the industry for like almost 50 years. So I know he knows some things, and that's why I picked up his book. And this right here, first series of Stability and Freedom, was based off that, right? I got a lot of good information, good downloads from that book. So I just want to share it here with you guys so that you guys can actually just get, enlightened as well, like I did. It's a good read. I might just leave a link in the bio in the description for you guys to go and check it out for yourself. It's a good read. So without further ado, I want you guys just to gain some insight on how to go about choosing a good financial vehicle for your cash flow. Okay, so I'm gonna go right into it. We ain't gonna waste no time. All right, so if you're preparing for like a long-term financial goals, what I found when preparing for like financial goals and things of that nature, there are 3 big dangers that we have to be aware of when we go to planning for financial goals. Financial savings, if you're planning for retirement, whatever it is you're planning for. Okay, I found that the first danger that we have to be aware of is taxes. A third of that, we got to already know to set that aside for taxes, right? The second is inflation. Okay, it costs more money to buy the same gallons of gas that we did last year or 5 years ago. And people are finding out that like, hey, look, every 5 to 10 years, things be twice as much than they was before, right? And the third is just market volatility. What I mean when I say market volatility, markets going up and down. Okay, if you remember my couple videos I did a couple videos ago, a couple weeks ago, I was talking about variable accounts, where they go up and down. So they're similar to the market volatility when it goes up and down. Because if you have your money in the markets during like a recession or an economic downturns, you will realize like that's not smart, right? You don't get predictable cash flow. You don't get predictable income. And if you're having to deal with the stock market's roller coaster, you got to deal with those ups and turns and stuff, right? So in this episode, I'm going to just share with y'all some keys of a prudent financial vehicle that I personally use, okay? And also being inspired from this book that I read, really simplified how you can score or rate any financial vehicle. I don't care if we're talking about annuities, mutual funds, bonds, 401ks, IRAs. You got money in the bank, you got money in the credit union, whatever it is, I'm talking about you too. Okay. Real estate too as well. So what I learned, the very first key element of a prudent financial vehicle is liquidity, right? Liquidity. The ability to have access to your money when you desperately need it. I wouldn't say desperately, but when you really, really need it, right? You need to have that liquidity to your money. And I'm talking about Cash App, electronic transfer, if you like need it in a hurry or something like that, right? You can go to the bank, ATM, anything. Okay. And a lot of financial vehicles don't pass the liquidity test. And if you excess your money, it's not favorable because it'll do what? It'll trigger some tax. Right? Like if you pull out money off Cash App, they're going to tax you for it. Or maybe a penalty. If it's in like an IRA or a 401k, when you excess money out of there, before the age of 59 and a half, you trigger taxes. You triggering some taxes right in and there. So let's say right now you have a 401k. Let's say you want to put out $150,000. You're only going to net. You're gonna want to net or gross $100,000 because you have to pay tax on some of that other money that you're pulling out. Right? That's not optimal. It's not. So I've made it very simple, and I created a cash flow management system here that gives several different examples of different financial vehicles most people have their money, and it's is ranging from fair, good, better, best. Okay, for liquidity, fair, you can access your money, but you can suffer from a loss due to market volatility. Now, the best for liquidity, you have tremendous liquidity and can access any amount within hours or a few days, right? Liquidity is really the number one key element, like the main one, all right? Now, the second set of keys I learned is safety. Click this button here. It's safety. Okay, safety of principle. And the reason why I personally got an IUL, an Index Universal Life Insurance policy, is because it's with the multi-trillion-dollar insurance company. Okay, you'd be like, why you got one, Malik? Why? Because it's with the insurance company that's been around for almost 130 plus years, right? Which is it's not just the backbone of America, but it's the backbone of the world, right? During the Great Depression, when the real estate market, housing market crashed, dropped down by 80% in value, the banks closed at like 40%. Some never reopened. It wasn't like a single legal reserve insurance company that went under during the Great Depression. They came out through crediting people 2 to 3.5% in '08. When like 400 banks went bankrupt, not one single legal reserve insurance company went under in '08. They came through with flying colors. In fact, look, if you don't know, the federal government asked they asked like 5 major banks in '08 to disclose where they had they tier 1 assets for liquidity and safety. And guess what they said? They said about 30 to 40 of their tier 1 assets was in insurance companies. So the safety of my money that I got in an IUL is great. Because when the market goes down, I don't lose. I may not make as much or anything like that, but I don't lose. Now, when the market goes up, I benefit. Okay. So for safety of principle, some of what I got down here for fair, some of my money is in the institutions or on platforms that don't have strong safety. Okay. The best, your financial vehicle is very low risk. Your money is protected from inflation and market volatility, like my IUL. So safety of principle is the number 2 key element here. Okay. The third one we have here is just rate of return linked to inflation. I made sure I put link to inflation down there because I want to talk to you guys about, if you've watched my previous video, I spoke about the S&P 500, where it's, linked to the things that inflate, that goes up and goes down. So when things in the economy goes up or go down, you can kind of look at the S&P and get a judgment on how it's doing. Because we want a predictable rate of return. meaning we know every year about how much we're going to be making, right? Either we making like every year, I know like boom, in my IUL, I know like, all right, I'm averaging at least 7%. Every year, I'm averaging 7% no matter what, compared to whatever whatever the S&P 500 does, right? And I won't go below zero. So historically, the S&P 500 averaged about 23.45% after the housing market crashed in '08. So let's say you have a 401k account with $500,000, and I got my IUL with $500,000 in it back in '08. Okay, we're just gonna go back in time. Comparing the rate of return on a $500,000 401k account and a $500,000 IUL policy in '08, when the S&P 500 dropped like 38%, the money in somebody's 401k, from that $500,000, they would have had $318,355. And in my IUL, because it was a negative number, it dropped below zero, I would have still kept my $500,000. It was predictable that I knew that I was going to keep my money right there because it was predictable. It was a predictable rate. Now, I said that to say when the market goes back up, the average rate of return on the S&P 500 when it went back up in 2009 was 23.25%. The IUL, my IUL would have averaged like a rate of return of 12.25% because of a specific cap that is on. Okay. And so the rate of return is like pretty incredible. All right. Now for here on this management system I got, for the rate of return, anything you earn is negated by market drops. Little net growth. You're not really netting anything. Immediately once you put your money in, it starts to ride with the markets. It goes down. And I spoke about this in my other previous episodes about if you guys don't know, I do put some money in crypto as well. Okay. But immediately when I put my money there, that it starts to riding with the market, start going up and down, whatever Bitcoin is doing. If Bitcoin is going down, guess what my money is doing? It is going down along with it. And if it goes up, it's going up. It's just going to start riding it. Little gross. I'm not netting much stuff. And the best over here is you're getting returns of 7% to 9% average returns. Tax-free withdrawals. Hedging against inflation. So the rate of return that I got here is a third key element for a great financial vehicle for cash flow. Okay. And the last one is, this one should be obvious, tax advantages, right? Especially with those three dangers with taxes, those tax advantages. Now, tax deferred 401ks are only when you go to access that money. Okay. It's taxable. Now, you have something that if you have something that accumulates your money tax free, you have to fund it, okay, with after tax dollars so that you can access the money tax free. Like my IUL, for example, I can put in more money and take money out without any penalties. It's more liquid, it's more safe, and it earns a predictable rate of return. It's totally income tax free. And if I pass away, if I die, y'all, it goes to my family tax free. Now, if I have, my 401k, it has to go through taxes before it comes to my family. But with this, my IUL, it doesn't. So as far as tax advantages, with my IUL, honestly, it's a perfect 10 in my book. It's a solid 10. Nothing else comes close to it. I'm just not even going to lie, cap. Nothing else comes close to it. I haven't yet to find any investment where you can put money in and not pay taxes on it. It's safe and it has predictable rates of return. But when I read that book, the Laser Fund, y'all, it put me on game. That's why I wanted to just share and create this chart here for you guys so that y'all can see like, wow, this is something that I've learned and got from the book. and went and did for myself, and now came through with this presentation for you guys. So we can all learn it together. And that's why it's one of my favorite financial vehicles for serious cash. For the tax advantages, here on the chart, I got traditional IRAs, 401ks. That's like a fair way, contributing money. It's not taxed. You pay tax on the distribution. And I scored the best score over here. Tax advantages on the contribution, the accumulation, tax advantages on the contribution, accumulation, distribution, and the transfer phase. So it's tax favorable, meaning tax free on the money that's being accumulated. Money that's being contributed to it is after tax dollars. And the distribution, when I get money coming to me, is coming to me income tax free. And when it transfers, if I pass away to my family, it comes to them tax free. So I just wanted to share this here with you guys. And I'll make sure I drop a link to kind of get in the book so you guys can kind of get it too. And if you want it, that's just if you want it. And yeah, that's all I have here. Just wanted to share this knowledge here with you guys. Just be sure to hit that like button if this is something that you like and you would love to, and you just love the information, you just love the knowledge, right? Just be sure to hit that like button. Be sure to subscribe. Leave a comment in the comment section, on some ideas of if you want to see something that you're interested in. I'm not sure, but I would just continue to keep making these videos, keep educating myself, and just keep educating you, YouTube family, and we'll just go from there. But yeah, thanks for watching, and I will make sure I be back for a better video for you guys. Another one, right? Another one. But yes, be blessed. Hope you guys got some information out of that. Please screenshot it. I don't have anywhere where this is where you can download this right here from yet, but I don't think I will. I'm not sure what I'll do with it. But yes, thank you guys for watching, and be sure to check out my latest video I just finished like Friday. Make sure you check that video out, and yes, see you guys again.